thank you for alerting me about this. I wasn't familiar with David Rogers Webb or the book, which has now been turned into kind of a documentary. My understanding is, just based on a little bit of research prior to this podcast, that Webb, again, a former hedge fund manager, now resides in Sweden on a small farm. So let's just dive right in. And I kind of read an excerpt about the book, The Great Taking. You give me your perspective on what is meant by the term, The Great Taking.
Sure. So I think that, a lot of us who have tried to keep abreast of what's going on between, kind of globalist, New World Order, economic agenda, we've seen, kind of a quickening of actions. We've seen the push for things like CBDCs. And what the Great Taking really does is it adds a crucial piece to the puzzle of what could likely be in store regarding a future world economic collapse and ultimately confiscation of assets. And the Great Taking spells out the legal framework that can make this possible. And so it's literally a story that goes back a few decades, but that has been memorialized into law around most developed nations, whether we're talking about the United States, Europe, Canada. And it's a process in the law where all financial assets, especially things like securities such as stocks and bonds, that most people, if they have a brokerage account and they think that they own them, that they really don't. That 83%, for example, in the United States of securities are owned by one individual corporation, a subsidiary actually of the Depository Trust and Clearing Corporation, or DTCC. In Canada, there's a similar organization called the Canadian Depository of Securities, CDS, owned by TMX, which also owns the Toronto Exchange, as well as other financial platforms in Canada. And so wherever you go in the world, what they've done is they've consolidated all of our assets, and they've put the ownership, the true legal ownership, the property rights under these corporations, and therefore made them subservient, if you will, to the creditors in the event of a collapse of these organizations, rather than to us as the owners. And what we now own, the legal term they created is a securities entitlement. So we have just a weak contractual claim on what we think are our assets, and they're actually legally owned by these other entities.
All right, so lots here to unpack. Let's just really simplify this so we understand what is at stake. Let's say I have $50,000 cash in a Canadian bank. Would that be affected?
So, if that bank is, the banking system is still different than securities. I don't want to get too technical, but indirectly, yes, that would be affected. Number one, most banks are involved one way or the other in the securities business. And the other aspect, that in the event of a collapse, the spillover, whether they're a brokerage or a bank, will be so widespread that banks, which obviously loan out, most of their assets. For example, in the United States, there used to be a 10% requirement that banks keep on their balance sheet. In COVID, that was reduced to zero. So banks are now legally able to loan out any amount of money. And so in the event of a collapse, if your money is in that bank, you might think that, okay, if this bank goes under, then there'll be the FDIC in the United States or a Canadian equivalent.
Yeah, we have a mortgage, not mortgage, deposit insurance, the Deposit Insurance Corporation. So we're covered up to a certain amount, our deposits.
Exactly. And those are actually just small organizations that are owned by the member banks that are not funded to handle a massive collapse. Even just the single collapse of the Silicon Valley Bank in the United States pretty much bankrupted the FDIC. And that's why the Federal Reserve had to step in, and they did big special assessments. But that was just one medium-sized bank. You can imagine in a massive financial collapse, there's no way that this money can be safe. I think a really good way to kind of think about this situation with all financial assets is to think about something like a home. So if you own your home, ultimately your name is on a deed with the kind of place of record. In the United States, it might be the county, and you own that. When you think about any type of stocks, let's just take a stock of Apple. Ultimately, the property rights, the ownership of that Apple stock is determined at the level between Apple and the Apple books and records that the Apple treasurer keeps. So, in financial terms, Apple is the issuer of the stock, and then they're required by law to keep records of who owns Apple stock. At one point in time, corporations would issue stock certificates, and you would get that, delivered to you. And on the company books and records, it would record Richard Serret owns 100 shares of Apple, and you were the direct owner of it. In the 1960s and 70s, this paperwork became so strong that at one point, actually, the New York Stock Exchange closed on Wednesdays because they couldn't handle all the paperwork. And they began a process called dematerialization. One of these words that just, you can't even believe it. But so they dematerialize stock certificates. And then what the next layer on this was to not only not have these physical certificates exist anymore unless you go through a very special and time-consuming process, that ultimately it was too much paperwork to keep track of all these individual owners. And so they said, well, we need to put it all under one system and create one true legal owner of all of these certificates. And the kind of machinations go a lot deeper than that, but that was the genesis of it. And then they added layers of complexity to it to make it even easier for any type of future confiscation, and also to put those assets at risk in the event of financial collapse.
All right. So if you have Tesla stock, if you have, stock in a silver mine, it's all the same. Or Apple stock, no more paper certificates. Somehow, through these machinations, there is now one legal owner, and that legal owner is the what did you call it? The clearinghouse, the Depositor Trust, the Depositor Trust Clearing Corporation.
Exactly.
And all right. So just continuing on with what is affected, you mentioned a home earlier on, and I have a deed on the house. And let's say I don't have a mortgage. Do I still own my house?
Well, not really. And this is how they're going to do this. So ultimately, when you own that deed and you own that home, you still own that home. And so right now, your home is not owned by the DTCC. There might be a mortgage lien that is wrapped up into a security. And so the lien holder, you might think it's a bank, or it might be a group of investors that ultimately own the mortgage on your home. But actually, since it's securitized, it is owned by one of these clearing corporations. And so right now, the fundamental assets that are owned by these corporations are in some sort of a securitized form. But ultimately, and this is where my work builds a little bit on what David Rogers Webb presents in the documentary, which is a great documentary that I recommend watching on YouTube. But what I've uncovered in my own research is one, a little bit more of the background on the DTCC and who they are and how they're set up. And I've also found out about their plans to add your home directly to their ownership. And so if you, for example, were to go to the DTCC website, and they put these white papers right up there, they have a recent white paper they put up there called The Tokenization of Private Assets, Driving Blockchain Interoperability, Liquidity, and Efficiency. And so their plan now is not only to take all of your securities, which they own, but to what they call tokenize, which is essentially taking the deed of your home, putting it onto the blockchain, and turning it into a security so that it can be traded back and forth. Ownership can be transmitted digitally with the flip of a switch. and they've been doing these big experiments. They call it at the DTCC, we believe digital asset technology offers exciting potential, where blockchain networks and traditional rails seamlessly integrate. We are committed to supporting the shift from blockchain experiments to production-ready capabilities. And this is for private assets, which would be things like cars, your car deed, your home. And so once this is complete and they're already getting ready for these production-ready capabilities, then not only will all of your securities or stocks or bonds be on this network, but also all what they call private assets, or they refer to it as real-world assets on the blockchain.
Again, even if I own my house outright and I have no mortgage, I don't own it. They own it.
Once this process is complete, right now you're still in a safe zone, but they're moving towards this. Larry Fink talked a lot about this at Davos, the head of BlackRock,
Yes.
that this is the next level. This is like everybody's gotten a little bit of wind of the CBDC, the central bank digital currency plans to move money onto the blockchain. Now they're starting to move financial assets onto the blockchain. And then the final thing is to put what they call real world assets onto the blockchain. And once this process is complete, it's going to be kind of game over. And the situation that they did this legally, like, they do this without permission. And so you might think, well, I'll have to sign this over. But you'll notice that there's a framework to do this without your acquiescence. And they did it, through law in the United States and places like Canada, through what they call the Uniform Commercial Code. So it didn't even require a congressional approval. It's done on a state-by-state basis. In Canada, I looked it up. It's called the Securities Transfer Act, or STA, that each one of the Canadian provinces has passed. It's kind of the same in each province, so that it effectively is a national law, but it's done on a state level. And I found the same terminology of securities entitlement in the Securities Transfer Act of Canada that exists in the Uniform Commercial Code in the United States. And these are the places where it states in there that you are only a beneficial owner. And then what it states is that a creditor of what they call securities intermediary, or the company that actually owns it, DTCC, a creditor under different circumstances, and they enumerate what those circumstances are, can have claim on your assets. And all that you, as a securities entitlement holder, have the right to is a pro rata share, because everything is in a pooled vehicle. There's no direct ownership between you and your security, a pro rata share of what's ever left over once these creditors are paid.
Unbelievable. It's outright theft.